So we're going to get into it today. My name is Abby. Sorry, I forgot to say it at the beginning. My name is Abby, and today we have Jennifer with us. And Jennifer is going to be talking to us today about how to recession-proof your finances. Jennifer is a CPA in the making with 5 years of accounting experience across various energy companies. She currently works as an accounting consultant with a Big Four accounting firm. Jenny is very passionate about personal finance, and she runs a personal finance blog called InsideYourFinance.com. And the aim of her blog is to help millennials take charge of their finances and become the CFO of their lives. Jenny also spends her free time volunteering with the Nigerians in Diaspora organization as their financial secretary. So we can see that Jenny has a lot of financial background and experience and a lot of knowledge to bring to us today. So I'm just going to hand it off to Jenny right now to get us started for today.
Oh, yeah. Zoom etiquette number one, don't forget to unmute. So let's start that again. Thank you, Abby, for that introduction. And first of all, I actually want to say thank you to Kike for, putting all of this together. I remember when Kike first told me to take on this, I agreed. And then I think a couple of days later, I decided I didn't want to do it because of fear. And, just like an hour and a half of speaking to her, she sort of just made me feel a little bit more confident in myself, and that's a gift that Kike has, is just, birthing purpose in people. So I just want to say thank you for really taking on that gift that God has given you. And also thank you to the pastors, Chini and Pastor Anayo of Kingdom Life Victory Church, for pretty much letting us do all of this under the umbrella of the church. Okay, so I'm going to share my screen really quick. I hope everyone can see the screen okay. All right, so like the title suggests, we're going to be talking about 5 ways to recession-proof your personal finances, and I've sort of titled it CFO Hacks, simply because in the event of a recession, a lot of companies, there are certain strategies that a lot of companies use to make sure that their bottom line is still intact. And so I'm just going to be sharing some tips. Trying as an accountant, I'm going to try to figure out a way to merge our accounting, reporting statements and all of that to our personal finance, because that's something that we can totally use. Like if multi-billion-dollar companies use these strategies that work for them, we can totally apply that to our own personal finance as well. So first of all, what is a recession, right? So a recession, by definition, is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Now, that was a mouthful, and I'm sure the economist grads in the house are nodding their heads in agreement, but that really didn't mean much to me as a non-econ person. So just breaking it down a little bit, there are key factors in a recession that we need to keep in mind that would affect us as individuals. And that is really that the economy slows down for at least 6 months. And then there's also higher unemployment and more layoffs, right? Again, companies are looking at ways to keep their bottom line. And so they're going to definitely lay people off in order to make sure that their expenses are low. And of course, there's also going to be a stock market crash. So these are just some key factors to keep in mind when we're planning for a recession. So with that said, the 5-step plan that we have is, number 1, you determine your financial position. So that's knowing your net worth. And then you pay down your high interest debt, increase your cash reserves, cut back on expenses, and diversify and grow your income. So those are the 5 steps that we're going to be taking a quick look at here. So the first thing is to determine your financial position. What's your net worth? So if you want to plan your finances for a recession, right, you need to definitely know where you stand right now. You can't really plan for something if you're not even sure where your starting point is. So depending on whatever financial plan you take on, you need to know if you're highly leveraged, like you have a lot of debt, do you have a lot of assets, do you need to rebalance your portfolio? And so it's key to first understand where you stand before you then go into making your plan. And so how do you determine your net worth? You take all your assets. So your assets would be your cash savings, your investments, your properties, your car, as well as personal property. So this one is a bit tricky. So it has to be something that is of value that you can liquidate, right? So you take all of that, and this is an exercise that you really need to, sit down, grab a pen and paper, and really go in and review every single item that you have. And so when you take a full stock of your assets, then on the flip side, you also have to take a full stock of your liabilities. And that would be your credit card debt, your mortgages, and your loans. So that would be student loans, car loan. And I have here money you owe a friend. So the reason why money you owe a friend made it on this list is because in a recession, people are going to remember those people that owe them money. So you want to make sure that you're at least keeping that at the back of your mind, because cash is king in a recession. So if you're planning, calculating your net worth, and you've come up with a good plan and you forgot that you borrowed, someone lent you $2,000 and you didn't add it to this, you might actually be setting yourself back a bit. So it's really key to have the full liability picture as well as your assets. And then when you do that, what you get is your net worth, right? So if it's a positive, it means that you own more than you owe. If it's a negative, then it means that you owe more than you own. And so once you have this full financial snapshot, then you can come up with a plan moving forward. So I guess here's just a simple plan for whatever you come up with. So if you come up with a positive net worth, then you still need to sit down and look at it like, okay, do I have, an emergency fund set up? Do I have, enough cash that maybe I need to, instead of letting the cash just sit in the savings account, maybe I need to, purchase some income generating assets or invest that cash, in the stock market. As well, you can also look at rebalancing your portfolio. So even if you have a positive net worth, you could also have a lot of your assets sitting in high risk investments. And so you want to rebalance that to manage that risk. On the flip side, if you have a negative net worth, then the first thing you want to definitely look at is paying off that debt that you're carrying. And then you also want to look at cutting back on expenses, because that would in turn help you pay back that debt. And then finally, you want to generate more income. So that's the first step. That's the first plan to, recession proofing your finances. So the next step is paying down your high interest debt, right? You want to manage your debt to income ratio or your debt to equity ratio. So keeping a savings account or investing while carrying a high interest debt negates your investment and savings gains. And that's just because most interest rates on savings accounts are about 0.2 to 3%. 3% is like the really high end, right? And most credit card interest rates are around 19 to 30%. So already you can see that even if you're gaining money, 3% of that interest rate on your savings account, you're losing money with the 19 to 30%. So it really makes sense to make sure that those high interest debts or loans or whatever that you have are paid down. There's a lot of misconception about credit cards and how, making the minimum payment is all you need to do. But the truth is that's how the credit card companies make their money, is from making you believe that all you have to do is make your minimum payments. Yes, that's good to help improve or keep your credit score high, but it's not good for your bottom line because you're losing money every month. The more money you leave sitting in a balance in your credit card, the more money you're losing because of those interest rates. So the key then is to minimize the cost of carrying that debt. I'm going to go into that a little further. And like I said, credit card companies make money off of the interest charges. So here's just a quick snapshot of what would happen if, let's use Emeka, for example. Emeka, decided that he wanted to flex during Christmas, or he had lots of gifts to buy for friends and family. And so he accumulated $5,000 in credit card debt. But then he also received a $5,000 bonus, right, the next year. So what would he do with this? So the first scenario here is if he puts all of that money into a savings account, all the $5,000 that he received in bonus into the savings account, his interest at the end of the year is only going to be $150, whereas he has accrued $1,000 in interest, because if we're assuming that it's a 20% interest rate on his credit card, So at the end of the year, you can see here that he's actually lost $850. So even if he has $5,150 sitting in his savings account, his credit card debt has gone up, and he's definitely losing money at the end of the year. The second scenario, though, is if he uses an 80-20% split, where he pays down, only puts $40,000 towards the debt and $1,000 towards savings. That way, he minimizes the net effect. Still has, a negative net effect, but he's still losing money. But at the same time, it's at least minimized, right? The third option would be that he's putting all that $5,000 bonus into his credit card. While that's good because then the net effect is zero, it's a bit tricky because if he runs into an emergency where he needs cash, he would have to go back into that credit card and start to accrue more debt. So in my opinion, this would definitely be the optimum choice, where he's keeping some cash savings somewhere in case of emergencies, but at the same time he's also minimizing the cost of carrying that debt. So this is just a quick snapshot of how to manage that cost of carrying the debt. And again, with numbers, it makes things a little easier to see how you're actually losing money if you're carrying a balance in your credit card at the end of every month. So how do we then minimize the cost of that debt? There are a few options. If you have high interest credit card debt, or high interest debt really in general, that you're trying to pay down and minimize, the two options would be a balance transfer and a debt consolidation. So the way balance transfers work is a lot of credit card companies would do special offers of 0% interest rates for 8 to 12 months. Now, these ones are really tricky because you have to make sure that you're making those payments. You have to make sure that you come up with a plan that you're going to make those payments between that 8 to 12 months, because number one, balance transfers come with a fee. So you have to pay about a 3 to 5% fee to transfer it. And secondly, the interest rates for these cards would end up being about 29.9%. So you want to make sure that you have a plan to focus fully on just paying whatever that balance is, if you do this option. The second option is the debt consolidation. So there are two lines of credit. You could get a home equity line of credit if you have a home. That way, the interest rate on those line of credits are usually around 3 to 5%. So then you're going from, a 19 to 20% or 19 to 30% credit card to a 3 to 5% line of credit. So that's one option. The other option is there are banks that offer debt consolidation loans. And another reason why this is also a great option is if you have, car loans that are high, credit card debt that's high interest, it'll make it easier for you to focus on just one monthly payment as opposed to having to pay, in different accounts, and as opposed to having different interest rates. So these are the two options. If you have, a high interest credit card debt or any other loan that you're really struggling with paying, the issue with credit cards as well is that when you feel like you've made some good progress with paying down your balance, you get slapped with, that 19-20% interest, right? So then it's like you're taking one step forward and another 10 steps back. So the balance transfer option would definitely help with that, because at least you know that you're only paying the amount that you owe in that 8 to 12 month period. So that's it with paying down your high interest debt. So now once you've determined your net worth, you've managed your high interest debt, the next thing you want to look at is cutting back on your expenses, and this is maximizing profits. So like I said, what a lot of companies do is, they look at two very important statements, your balance sheet and your income statement, right? The purpose of the income statement is to make sure to really just see the income versus your expenses, right? So a lot of companies will want to make sure that they're maximizing profit, and one of the easiest ways to maximize profit is to cut back on expenses. And so that's something that we can also apply here. So a couple of ways that we can cut back on expenses is to review your bank statements. Personally, I review my bank statements bi-weekly, but that's just because I'm a numbers or personal finance nerd, and I love to just understand fully what's coming in and out of my account. But I would say a good rule of thumb is to make sure you're reviewing it monthly at the very least, or maybe quarterly. The key thing with reviewing your bank statements is that you want to make sure that you have a full understanding of how much you're spending, what you're spending your money on, and whether or not those things are actually useful to you, right? So for example, you might be paying for subscriptions that you signed up for years ago that you don't actually need anymore, right? Or you can even really just look at it and ask yourself, do I really need a Netflix, Hulu, Prime, and whatever else is there? Do I really need all of that in the same month? Because the truth is, you probably don't watch all of them, all those different accounts. You probably don't watch movies that often, right? I know right now we're all sitting at home, but chances are you probably don't need all 6 or 7 of those subscriptions, right? So reviewing the bank statements is good because then you're able to really sit down and ask yourself whether or not you need to pay for the things that you're currently paying for. Another key thing too is reviewing your fixed expenses for better rates, right? A quick story here with my own personal experience with doing this. I realized that I was overpaying for my car insurance. And that was just because I had been with this company for 5 years and I thought, I was kind of loyal to them. And so I was really comfortable paying whatever it is I was paying until I started doing this. And I realized that my car insurance had actually been going up year over year. And to me, I thought, I hadn't claimed any accident. I had no accidents. I had a clean record. So it didn't make sense to me why my premium kept going up. And so what I did was I called the insurance company. I said, hey, I've been with you for 5 years. Can you give me a lower rate? And they said no, flat out. And that's fine, because what that meant was then I had to go shopping for new insurance premiums, right? And so I used ratehub.ca, which is an amazing website if you want to compare rates for really anything: insurance, phone bills, credit card rates, whatever it is you want to compare. And so using ratehub.ca, I was able to do a quick quote, and I saw that I could have been paying much less than what I was paying with my current company at the time. And even taking it a bit further, I also found that the company I was with, has something called an employee savings plan, or employees incentive plans, where they actually give you group plans. So some insurance companies and phone companies will actually give group plans for certain employees. And I think a lot of companies have that option. So reviewing your bank statements would definitely give you the opportunity to sit down and really ask yourself, like, maybe I could get, a cheaper rate for your phone bill. Maybe you could get a cheaper rate for, whatever those fixed expenses are that are actually, dripping from your bank account. The other option as well is to track your expenses, right? Setting targets for variable expenses using mint.com really helped me and saved my life, really. I cannot stop singing the praises for Mint. It's just an amazing web app where it actually links to your bank account directly. And so you can set targets for each of those variable expenses. For me personally, I found that, when I did this review of my bank statements as well, I found that I spent a lot of my money on food. That's where a lot of my money went towards. Not like I didn't have food in my house, but because, I found that I was buying lunch every day, buying coffee, eating out, doing brunch every weekend, those little expenses add up, right? So the key thing here with tracking your expenses is making sure that, you're setting a target. So then you're reminding yourself every time you make a payment for that target that you set, Mint will send you a notification saying, hey, here's how much so for example, if you set a $300 target for food, for instance, for eating out, and by week 2, you've already spent $250, right? Mint will send you that notification and be like, hey, you're already $250, you only have $50 left for the rest of the month. And so that kind of helps you plan around those variable expenses. So suggested rule here is a 50-30-20 split, which really just means that you're spending 50% of your income on your needs, you're 30% on your wants, and then 20% is going towards your savings and investments. I think if you struggle with budgeting and planning and tracking your expenses, for sure, using the Mint app would definitely help you a lot, because a lot of us are usually on our phones, and a lot of us, do everything on our phones. So having that app on your phone is handy. You can get your notifications. You can set targets, set goals. You can also set savings goals as well as tracking your expenses. And then also, just if you're new to budgeting and you're not quite sure where to start, using that 50-30-20 split would be a good place to start with cutting back on your expenses. So the next step then is increasing savings, which is maximizing your cash reserves. Now, a lot of people have a problem with saving, and the truth is it's probably because of the previous step, right, which is cutting back on expenses. So hopefully by the time you've reviewed those bank statements, you've reviewed your monthly expenses, you're able to then find that you've been able to shave off a few of those monthly expenses that come out of your account, and that means that you're able to save more. So a few tips and tricks for maximizing your savings would be, the first and most important is paying yourself first. Now, this option is really good because you don't have to think about it after you've already spent, right? This method is, maybe a paycheck comes in, you're setting up an ASP in your bank that's saying 10% of that paycheck already goes out of your checking account. So you don't even see it. Right? And then whatever is left, you can then decide, do I want to keep spending that, or do I want to save even more, right? But I would say that setting up those automatic saving plans with your bank would definitely help if you find that you've struggled with putting money away. And then there's a rule of thumb here that is at least 10% of every paycheck should go towards your savings, right? The barest minimum is that you should be paying yourself 10% of your income. That's just a general, like, basic rule of thumb, but of course if you can do more, that would definitely be much better. Another savings trick that would help is naming your savings account. It's very dangerous to have your emergency funds, your long-term savings, and travel funds all in one account, because you could end up dipping into your child education fee, or your down payment savings that you've done so well accumulating, right? So the key is to name your savings account. What that just means is creating different savings buckets. So have a separate account for your emergency funds, have a separate account for your long-term investments, and a separate account for your short-term. And I just have something here, travel funds. Really, it depends on what that thing is that you like to do. Personally, I enjoy traveling, and so I have a travel savings account. And what that really does is, if there is no money there, it means that I'm not traveling anywhere, right? So at least I know that anytime I take money out of there and I travel, I have, this confidence knowing that I'm not, making my future self hate me for dipping into my future savings, right? So whatever amount is in that travel funds is used for travel. It could be, if you're someone who loves to shop, or who likes expensive stuff, you could create an account, a savings account that's just dedicated towards shopping, right? So then you know that you can shop without having any guilt of, dipping into your future savings. And so, of course, having your emergency funds is really key. Another really key tip is separating your savings account from your checking account. This is something that has helped me personally, because when you have a checking account and you see all these, $5,000 or whatever sitting in there, you feel more tempted to transfer the money and spend it, versus if you created a completely different savings account, maybe in a different bank that does not have a debit card. So two things: separating it and creating a completely different bank account with your different savings. That way you're not seeing it every time you log into your account. That's number one. And number two is, it would also be key to have a savings account that doesn't come with a debit card. And this one is really just a personal opinion. I personally use online banks. Number one, because they have really higher interest rates than most banks do. And number two, it's most of them don't necessarily they do have the debit cards, but if you don't want it, you can opt not to get it. And so that way, I don't, unless I need to go in there to do any major purchases, I wouldn't feel tempted to go into that account and transfer the money for regular purchases, right? So it's key to have separate savings account so that it's not in your view. And so that way you're not tempted to go touching it. So the key thing though is creating different savings buckets. Your emergency funds, the rule of thumb is that it should be around 3 to 6 months of expenses. In a recession though, I would say you should probably have a little bit more than that, because what typically happens in a recession is that people lose their jobs. So then you want to also ask yourself, how long is it going to take between when I lose my job and when I get a new job, right? So you want to make sure that if it's only 3 months, then fine. But just to have that good buffer, I would say aim for 6 to 12 months of your living expenses in your emergency funds. And of course, your long-term savings or your short-term savings could be, if you're trying to buy a house, you could save your down payment in either of those. Another key thing with your emergency funds is that you should definitely not invest them. Your emergency funds should be cash, because they're for emergencies, and you want to be able to have quick access to cash in case something happens, right? And this also helps with, buffering against you going back to using your credit card debt, or incurring more credit card debt. Okay, so number 5 then is, I guess the plan here is you understand your net worth, you've paid down that high interest debt, you have cut back on your expenses, and you've increased your savings. You have a good, 6 to 12 months of emergency funds saved up. And now you can now look at how to diversify or grow that income. Again, if you remember, one of the key factors in a recession is that a lot of people lose their jobs. There are lots of layoffs. And so it's very dangerous to have just one source of income, right? So you want to make sure that you're at least trying to diversify that income. Or if you don't want to, do something else, then maybe you want to grow that income by investing it. So a few options for diversifying and growing your income would be to invest in the stock market. The stock market is very, very, very risky. And so you want to, first of all, understand your risk tolerance. Your risk tolerance would differ depending on where you are in your life. For younger people without any family, we typically would have a higher risk tolerance, because we know that with the ebbs and flows in the stock market, things will always get back, maybe 10, 15 years, whatever, however long it takes, it would always normalize. But then if you're nearing retirement, then you probably want to reel that back a little bit. You want to manage that risk and make sure that you're not overextending yourself in the stock market, because in the event that it crashes, you've pretty much lost everything, right? So you want to definitely make sure that you bear in mind what your risk tolerance is, and that would then determine what your investment strategy should be. So just a few examples with, investing in the stock market would be investing in dividend paying stocks. Dividend paying stocks really just means that, there are certain companies that pay dividends either on a quarterly or an annual basis. So that way you're actually getting income from the stock that you've invested in. Another option would be ETFs or mutual funds. Those are lower risk investment vehicles versus you going in and picking the stock by yourself. And then another option would be REITs or REIGs. So these are real estate investment trusts or real estate investment groups. So the way these work is that a bunch of real estate companies come together and put whatever it is that they have on the stock market. So you're pretty much buying a piece of those real estate investment companies, right? Coming together to sell a share of whatever properties it is that they own. So these, in my opinion, are safer investment vehicles versus going in and just buying stocks. If you feel confident doing that, now is actually a pretty good time to invest in the stock market, because a lot of stocks are currently trading at a discount, but you also need to tread carefully, because sometimes you want to actually look at the industry as a whole and not just the company. So a company could have a good track record, but their industry as a whole is failing. And so if that's the case, then you probably want to stay away from those kind of stocks. The second option then for diversifying your income is investing in yourself. You want to try to develop new skills. I know that a lot of online training companies like Udemy and Udacity have offered certain discounts on some courses. So you want to develop those new skills that would either, number one, help you, get a different job if you lose your job, or number two, help you get a raise at your current company. Another option is that you probably want to freelance. Upwork is an amazing place for freelancing. If you have some free time on the side, you could, do whatever it is that you feel comfortable. Some people go on there to, turn their passions into their freelance jobs, where they do their 9 to 5, on a separate time. So some people could be engineers on a 9 to 5 and could decide to go do poet writing or reviewing of essays and whatever it is on Upwork. So Upwork is a great place to go in there to diversify your income. And another option for diversifying your income is starting a side hustle or investing in a side hustle. So if you have a friend who, started a company that you believe in, if you believe in the person and believe in the business that they've started, then it'll be a good idea to sort of invest in them and, find some sort of contract where they're giving you a share of that income. I know that there's a session that's going to be on how to turn your passion into a business. So that'll be a good session to attend if you want to figure out, if you have some passions or some skills that you have and you want to start a business using those skills. It would be a good session to attend. But these would be your best bet for diversifying and growing your income, which is investing in the stock market, developing those new skills, freelancing, and starting a side hustle. So here are just a few tools that I've mentioned. So mint.com, of course, that's a good tool for budgeting and tracking your expenses. EQ Bank is one of the high interest savings accounts that I personally use. I've used them for years now. I believe EQ Bank has a 2% interest rate. Wealthsimple is also a great platform to use for, trading stocks or even just mutual funds, setting up your TFSAs and RSPs. And they also have a 0.9% interest in their cash savings. And of course, Tangerine, Coho, Udemy, and Upwork are great for investing in yourself. Fiverr is also a great freelancing website. Milo.com is an expense roundup company. So this is another way to actually help increase that savings. So what Milo does is, if you spend $5.50 on an item, it rounds that up to $6, and then it saves the 50 cents. So it's a much slower way of putting money away, but at least you're putting something away without even thinking about it. So I think that's a great one to look into as well. So here's just a quick recession-proof financial snapshot. So going back to Emeka, let's use him as an example here. So he figured out what his net worth was, and he, I guess, realized that he had a negative net worth. And so he found, this was his plan, was to pay down his high interest debt. So he's paid it down to a manageable ratio. So a good ratio to keep in mind is that your debt to equity ratio should be around 30 to 40%, or your debt to income ratio rather should be around 30 to 40%. So if he's brought down that high interest debt, then he says, okay, now I can actually start saving. So he's paid down his high interest debt. He's also cut back on his expenses. And now he's put together his 3 to 6 months of emergency funds saved in cash. Now he can start, investing and thinking about his future and saving for those short and long-term goals. And then after he's done that, he can then start a side hustle from a business, or he can start a side hustle from freelancing. One thing to mention though is that you should definitely not invest your rent money. You should definitely not invest money that you would be scared of losing. So make sure that you have a good chunk of money saved in cash, and then you can start to invest and play in the stock market. Okay. Thank you very much. That brings me to the end of my presentation. I will be passing this on then to Abby.
Alrighty. Thank you so much, Jenny. That was actually so insightful. I learned so many things that I would definitely be going back to review now. I don't think I've ever actually reviewed my bank statement. So that was great. Thanks for that. So now we're going to go into questions. You know, if you guys have any questions at all about your finances, please put them in the chat. And Jenny will be happy to answer them for us. So we do have a question right now. The first one is, so what is the role of generosity, giving, kindness, philanthropy in recession-proofing your finances?
Can you repeat that?
Sure. So what is the role of generosity? So like giving or, you know, doing philanthropic work in recession-proofing your finances?
Well, okay, so again, this goes back to having a full financial snapshot, right? Understanding where you stand. Of course, it's really good to give, it's really good to be generous, but you know, we also have to use wisdom. So you need to first of all know, you know, how much do I have to cover my expenses? Do I have enough for, you know, in case I lose a job or, you know, whatever it is that comes your way? Then if you find that you have that good plan set up, then you can start to, you know, come up with a plan for giving and being generous. So it's all about planning. It's all about making sure that you know where you stand first, and that you're able to cover your personal expenses first, and then you can plan for that. Another key thing too would also be to, you know, if you, part of budgeting and part of creating those savings buckets is if you can create a savings bucket for generosity and giving and all of that. So even in the midst of planning and putting money away, you know that you still have some money out there for giving.
Awesome. Thank you so much, Jenny. So our second question here is, can you recommend some industries to us to invest in during this pandemic?
Wow. That's a very dangerous one because I don't want anyone coming from my head if I recommend an industry and they lose all their money. But one thing I'll say though is that you know, tourism right now has taken a huge hit. And so the question then is, would it go back? Like, are human beings going to stop traveling and, you know, stop moving around? No one knows. But the fact is that right now, they're like, you know, airline stocks, cruise stocks, and all of that, they're all selling at a discount. So that could be something to look into, but no one knows whether or not it's going to get back up, because there's a lot of, you know, there's a lot of analysts that are saying that, you know, consumer behavior is going to change. So a lot of people are probably not going to travel as much as they used to, but no one knows. So I didn't tell you to, but I think, you know, you can look that way and make your decision based on that.
So basically, disclaimer, you didn't say it, but you know.
I didn't say it. Yeah, but yeah.
Okay. So basically, Jenny saying she didn't say it, but you guys can go take a look.
Yeah, take a look.
Okay. So basically, our next question is, so at the beginning of the presentation, you talked about assets and liabilities, and you listed under assets that a car is an asset. Are there instances where a car would actually be a liability instead of an asset?
Yeah, okay, so that's actually a good question, because that's a debate really within a lot of people. But the thing is, a car is an asset. It is a depreciating asset though. So normally assets would appreciate in value. They would give you, you know, future value returns for whatever it is that you invested in it. But a car on the flip side is a depreciating asset. And that's number one. Number two, you also have to, you know, pay for maintenance, pay for gas and all of that. So you're also bleeding money from there. But the thing though, the reason why it's still listed as an asset is that it has a value. So in the event that you need to liquidate, if you need to, you know, get some cash or whatever, you can still sell the car, albeit you're probably not selling it for the same amount you bought it because it's depreciated, but you can still sell it for some value, right? If you're paying something on that car, then you definitely want to have your car loan listed as well, so that it nets out to what the true value is. So that's why a car would be listed. I guess in instances where it's a liability, it's always a liability because you're always having to pay stuff for the car, right? But then you can always sell it for cash if you need to.
Okay, thank you so much. All right, so our next question is, do you have any recommendations on ways people can learn more about investing in stocks? Would you advise that we use financial advisors?
Well, so personally, I like to do things myself, but at the same time, I've also, made a lot of mistakes. So even in investing, I invested a good chunk of my money in, stocks. Sometimes I actually also invest in cryptocurrency, and I've lost a lot of money there. So maybe if I had gotten a financial advisor, I would have, they would have told me to stay away from oil and gas. Maybe, I don't know. But then in order to learn about trading in the stock market, I would say reading a lot of personal finance books. There are lots of information out there. One book that's actually really good is, I'm currently reading this, Money Master the Game by Tony Robbins was really good. Fool.com is also a great website. It's actually called the Motley Fool. Don't worry, they're not insulting you, but it's a great website to go on to actually, read up on. Sometimes they actually also recommend mutual funds or ETFs that you can purchase, right? But if you're a first time investor, you can go on there to research whatever it is that you want to know about trading in the stock market. Investopedia is also a really good place to go to read. It's more theoretical, so they wouldn't actually give you any opinion, but it'd be good to learn the terms and tricks and tips for investing. On getting a financial advisor, I would say it depends on you. If you feel like you're more comfortable going to talk to a professional, then go for it. But I think I would personally say try first. Try to get that information, try to do some research. If you can't find anything, then you can go get a financial advisor.
Okay. And just going off of that, so I know at the beginning of that question, you did say that, you'd like to do it yourself. And does it help that you have that financial background and that accounting background? Like, for example, for people like, some of us didn't study finance, we have absolutely no idea, okay? Would it still be advisor first on that first try yourselves, or maybe get like an advisor that first time to explain things to you so you have an understanding before going out to try to figure things out yourself?
Yeah, that could also be a good approach. If you feel, again, it goes back to you as a person, right? Whatever you feel more comfortable doing. I don't think that my financial background actually really helped, because I'm an accountant, and there's a key difference between an accountant and a finance person, right? So even personally, like as an accountant, my own job is really just to create reports and tell them what happened in the past, right? Whereas they're financial specialists that are more, doing all the financial calculations, so these are actually two different types of professions. But to your point though, maybe because I'm always in the numbers, I kind of pick up on those things faster. I don't know, but I don't think that it's harder for anyone else as long as you try. Like there's so much resources out there that are also free. If you try and just tell yourself, what, I want to learn how to do this stuff, then I don't see it being any more difficult for anyone else.
Okay. Thank you. Alrighty, so our next question is, so how should we approach RRSPs and TFSAs as it relates to our savings and long-term savings?
Okay, so RRSPs and TFSAs are great vehicles to put your money in, right? The RRSP, the reason why I would suggest actually using both an RRSP and TFSA is because an RRSP has a tax saving benefit to it, right? So if you invest, if you put, I don't know, maybe $100 in your RRSP, it reduces your taxable income, right? So reducing your taxable income means that you get a higher tax refund back, right? Whereas with a TFSA, you're investing your after-tax income. So whatever gains and whatever it is that you make within your TFSA doesn't get taxed. So I would totally say use both your RRSP and your TFSAs, invest in those. Don't just keep them in cash. Yes, maybe you can have your emergency funds in cash in your TFSA, but you can always open another TFSA for your long-term investments or your short-term investments. So if you invest within your TFSAs, you know that whatever gains you make, you're not going to get taxed on that. right? Now, with investing in your RSPs, same thing. You can do that. You can put in, all your long-term savings in your RSP. The only caveat to that, though, is that if you withdraw the money from your RSP, you have to pay it back, number one. Number two, the CRA would consider whatever amount you withdraw as income. So that means you're going to get taxed on whatever it is that you withdraw. And I know that the only times where you can withdraw without having that tax implication is for buying your first home or for education. So there's that little bit of limitation on how you can withdraw money or spend from your RSP. So with your TFSA, you can withdraw it whenever you want to. So that's, I guess that'll be, I don't know if that answers the question, but then I think if you're trying to decide between opening an RSP or TFSA, I would definitely say do both, because you're benefiting from the tax benefit of the RSPs. And then you're also giving yourself that ability to, get easy access to your TFSA whenever you need it.
Okay. Thank you. All right. So our next question is, what is your best view? What is your view on the best way to determine renting versus buying a home from a financial perspective?
Okay. Well, okay. So my view on that is totally, just sit down and do the numbers, right? I think that when it comes to personal finance, everything is really just sitting down and getting a pen and paper and, getting a full snapshot of both options, right? If you get a full snapshot of how much is it going to cost for me to rent, and that means taking your, the actual rent, the monthly rent, and then your utilities and all your other expenses, take that total and compare that to your mortgage, your property insurance, your condo fees, the interest that you're actually paying on that mortgage, right? Take all of that, and as well as your utilities, your maintenance on your home. When you compare those two, it's actually easy to say that renting is a lot cheaper than owning your house. But then again, there's so many other factors that go into making that decision as to whether you should rent or own. But I think in order to make, if it's just from a financial standpoint, you totally want to, just sitting down and doing the numbers, it's very clear that renting is a much cheaper on a monthly basis than owning a home.
Alrighty.
Yeah.
So our next question is, so how much would you recommend EQ Bank? Would it be the same level as Wealthsimple, or should we be a bit skeptical about it?
Again, Jennifer didn't say this, but okay. So personally, I use both. I use EQ Bank and I use Wealthsimple. I use Wealthsimple more for investments and trading stocks, and I use EQ Bank just for the savings. So EQ Bank is good because it's 2% interest. Like I don't know any other bank that has that in Canada, and if you guys do, like, share that with me. But I've used EQ Bank for about 4 years now, 3 years actually, and I haven't had any issues whatsoever. So I would recommend them, but then I would also say you should probably not put all your money in there in case anything happens, because that's the thing with these online banks, right? There isn't like a physical place that you can go and ask them to give you your money. So I would say, yeah, I would recommend EQ Bank just because of the high interest rate, but I'll also say you should definitely tread carefully. You can put, like, personally, that's where, all the miscellaneous savings and, money that I know is not going to break the bank if I completely lose. That's where that sits. Whereas with Wealthsimple has, they have a higher amount of insurance, I think, on whatever it is that you put in there. So if in the event that they lose your money, that you can definitely get it back. So I would say just do it. Just close your eyes and do it, but don't call Jennifer.
Okay. So we have a question here saying, can you negotiate a payoff amount with your credit card company if you can't afford to pay down your whole balance?
That's an interesting question. I know for sure you can totally negotiate interest rates, but I think that's probably something that you need to call your bank, whatever company it is that you have your credit card with, and confirm with them. Some, especially now because of COVID, a lot of companies are more lenient with that. So it's definitely would be worth just calling them to confirm.
Okay. And then taking us back to the question about rent or buy, what of the equity building factor? How does that play out?
Equity building factor, yes, fine. You are definitely building equity in that regard. But again, you have to also look at both sides of the coin, right? While you're building equity, you're also paying, interest, right? Those interest payments will never come to you, right? It's just money that you've lost, right? So yes, it's good that you're building equity, but at the same time, maybe that money could be, could you also get that same amount of equity that you're building somewhere else, right? Especially with those interest payments, maybe you could actually invest it in a business or in an investment or whatever that could give you, if not the same, maybe better returns in that same period of time, right? Which most mortgages are around 25 years, right? So I think, again, yes, you're building equity. Yes, that's good. But you're also looking at, depending on the kind of house you buy, if you buy a condo or a townhouse condo, you're paying those condo fees that will never come back to you. You're paying that interest rate on that mortgage that will never come back to you. And in some very rare cases, your property is actually not even appreciating, right? It's just going to stay stuck there. So yeah, you can definitely earn, you can get that equity, but at the same time, you might actually be losing money on owning a house. I don't know. And again, with personal finance, I think that's why it's personal, right? You have to also look into look at your own financial situation and look into what you feel more comfortable with. Because I know also with owning a home, there's a psychological aspect to it, right? Like just feeling like, you're more confident knowing that you have your own property and no one can come and kick you out of your house, right? So there are so many other factors outside of the financials to look into.
Okay. Thank you for that. And just one quick question before we end here. So I know we have quite a couple young people on this call, and we have some people who are just finishing out of university or just getting into the workforce. So what advice would you give to them in starting out their finances? Because I know a lot of young people, we graduate, we're so excited, we get our first job, and then we start going money crazy. We're spending here and there. So what advice would you give to young people who are just starting out on how to make sure go down before they even start?
Okay, well, first thing I'll say is if you already put your mind in a way, get yourself in a mindset where you want to have money we want to save money, or you want to build wealth or whatever. So I would say the first thing to do is get into that mindset, right? And that's number one. Number two is understand that time flies, right? So while yes, it's good to when you get your first job, you can spend, you splurge and all of that. I totally understand that, but it's good to just get yourself in that mindset that, okay, I'm going to need to take a step back and start to plan for my financial future. It's never too early to plan. It's never too early to save for retirement. So I guess the key things then I would say is for someone who's just first starting out is sit down and come up with a plan. Like, where do you want to be in 5 years, 10 years financially, right? What does that look like to you? What are things that you enjoy doing? What are things that you spend a lot of money on? Once you come up with those things, then you can start creating little, plans around that, right? So, for example, if it's managing your expenses, I'm not saying you shouldn't spend money at all, but what's important to you. If it's personal care as a woman, buying hair, doing your nails and all of that, then make sure that that's fine. You can still do it, but make sure that you're putting a target on that, right? So that you're not just open-endedly spending. Same thing with savings. Come up with a plan, like, okay, how much do I want to save every month? How much do I want to have 10 years from now, right? Where do I want to be? Then you can now work backwards from there and say, okay, this is how much I need to save. A good approach that works for me is determining what I want to have saved, in 5-10 years or whatever, and then working back from that. Then that also determines how much I spend at the end of the day. So once I know that, okay, I've made all my savings or whatever is left, if it's only $50, it means that I'm only spending $50, right? And that also manages how whatever it is that you're spending your money on. So first thing I would say is definitely get a lot of books. There's so much information out there, especially on the internet these days, right? So much information out there to read and to, you know, get some information about personal finance, investing, stocks, and all of that. So read up on that. Follow my Instagram page, Inside Your Finance. That's really key. And then, you know, then you come up with your plan, right? Like just sit down and ask yourself where you want to be 5, 10, 15 years from now, and then you go from there. But I'll totally advise getting, you know, mint.com is an amazing, the Mint app is an amazing app for managing your finances, for sure.
Awesome. Thank you so much, Jenny. And I can attest, I follow Inside Your Finance. She does actually put some great tips on there. So if you're not following it yet, go follow her on Instagram and, you know, get your finances right. But thank you so much, Jenny, for, you know, coming to talk to us today. I personally learned a lot. I hope everybody here did learn something and take something away from this. But while we have you all here, if you please take a moment at the end. We do have in the comment section there, we have a feedback form. If you could please take a moment to fill it out, let us know what you loved about it. If there was anything, you know, just anything you would like to let us know, please do that in the feedback form, and we would really love that. So that's going to bring us to the end of our 5 ways to find recession-proof your finances. And we're just going to go through a couple announcements here before we let you guys go. So if you would like to get in touch with us, we are Kingdom Life Ministries. So our email address is on the screen. You can reach us at kingdomlifeministries@gmail.com. If you send an email there, somebody will be sure to reach out to you and to follow up. Also, we have our next webinar coming up. Okay, we have Dr. Deborah Motilewa. She's going to be giving us 5 tips for creating a business out of your passion. You absolutely do not want to miss it. It's going to be a great time as well. It is going to be on the 30th of May, 2020, exact same time, 2 p.m. Mountain Standard Time. We hope to see all of you there as well. Also, we have a couple books here in our that would be amazing. This is a book written by our own pastor. It's called Path to the Dream Life. Great book. It was basically to that, you know, led him to the life that he found himself in. I have read the book. It is a great book, and I do encourage that everyone reads it. We do have another book on here by our own Pastor Kike as well, Fulfilling Purpose in Everyday Life. I have read it as well, and I can vouch that this book is actually a great book. If you want to, you know, find out where to start in your journey with purpose, if you want to find out how do I start, where do I even begin, this is a great book for you to get. She put a lot of thoughts into this book, and it really blessed me, and I hope it blesses somebody else who decides to read it. And also, as we've said before, Jenny does have a personal finance blog. It's called Inside Your Finance. On Instagram, you can reach her there. She does also file personal and small business taxes. So if you need your taxes done, Jenny is your person. You can reach her on her Instagram page at insideyourfinance.com, and she will be happy to get that done for you. So that is everything that we have for you guys today. I'm glad you guys were all able to join us today, and I hope everybody has a great rest of their day. The weather is great outside, so maybe take a few moments taking some sun, and we will see you guys